How do commodity ETFs, ETNs, and ETCs differ? Imagine trying to invest in gold, oil, or agricultural products without actually buying barrels or bars. That's where these investment tools come into play. They let you gain exposure to commodities through stock-like trading. But not all of these tools are the same, and understanding their differences can help you choose the right one for your investment goals. Commodity exchange-traded funds are like baskets of assets. When you buy one, you own a small piece of a fund that holds physical commodities or futures contracts. For example, a gold ETF might hold actual gold bars or futures contracts that track gold prices. These funds are regulated as investment funds, which means they have rules to protect investors. They also offer diversification because they often hold multiple commodities or related assets. You can buy and sell ETF shares just like stocks, and they trade on stock exchanges during the day. Commodity exchange-traded notes are different. They are unsecured debt securities issued by banks or financial institutions. When you buy an ETN, you are essentially lending money to the issuer. The ETN promises to pay you based on the performance of a specific commodity index, minus any fees. But since they don't own the underlying commodities, your return depends on the issuer's ability to pay. If the issuer faces financial trouble, you could lose your investment even if commodity prices go up. ETNs trade like stocks and sometimes have tax benefits, but they can be less liquid and more complex to understand. Commodity exchange-traded commodities are mostly used in Europe and Australia. They are debt securities issued by banks or financial companies that track the price of a single commodity or a small group. These are often backed by physical commodities or futures contracts, giving direct exposure without owning a fund. Unlike ETFs, ETCs do not have the same investor protections, so your invested capital is more exposed to the issuer's credit risk. They are regulated under specific rules, like the European Union's UCITS directive, which provides some oversight. ETCs are popular for focusing on just one commodity, like copper or oil, and they trade easily on exchanges. To sum up, the main difference is ownership. ETFs representing ownership in a fund that holds assets. ETNs and ETCs are debt instruments issued by banks or institutions. ETFs usually carry market risk but are safer because they own the commodities. ETNs and ETCs add issuer credit risk since they are unsecured or secured debt. ETFs tend to be more diversified, while ETCs often focus on a single commodity. Regulation also varies, with ETFs generally having more investor protections. Your choice depends on how much risk you're willing to take, whether you want broad or focused exposure, and if you prefer owning assets or just tracking their prices. Each has its place in a well-rounded investment plan.